Welcome, financial leaders, to this explainer. We are jumping right into the massive structural shift that's fundamentally reshaping institutional portfolios away from public markets. I am absolutely thrilled to guide you through this research and unpack exactly how modern wealth is being aggressively reallocated today. Here's our roadmap for today's briefing. 1. The death of 60/40. 2. The rise of private equity. 3. The 30-30-20-20 portfolio. 4. Democratizing alternative investments. And 5. Tokenizing real-world assets.
All right, Section 1, the death of 60/40. Let's confront the harsh reality currently facing traditional allocation models.
So is the 60/40 portfolio actually dead? I know, it's a highly provocative question. For decades, holding 60% stocks and 40% bonds was the absolute gold standard, really ever since Harry Markowitz formalized modern portfolio theory. But after consecutive years of violent correlation breakdowns, sophisticated allocators are waking up to the fact that this default framework might just be obsolete. Think about the number 3,952. That's it. That is the total number of U.S. public companies today. Why is that such a big deal? Well, back in 1997, that number was over 8,800. The public markets are literally shrinking. In fact, global IPOs plummeted by 45% between 2021 and 2023. If you're relying entirely on public equities, you are fishing in a rapidly shrinking pond. And the massive growth? That's happening long before a company ever rings the bell. And it's not just a shrinking equity market, right? We're facing severe macroeconomic headwinds. That negative stock-bond correlation that made the 60/40 portfolio feel like magic, it really only existed during the disinflationary anomaly from 1990 to 2020. That regime is officially over. When you factor in the brutal bond math, where 1% to 2% real returns after taxes and inflation are just the norm now, a 40% bond allocation isn't a stabilizer anymore, it's an anchor. Section 2, the rise of private equity. Let's look at where the smart money is actually going. The private market boom we are seeing right now is nothing short of exponential. By mid-2023, private market assets under management skyrocketed to $13.1 trillion, compounding at nearly 20% annually since 2018. But you know what's even more staggering? There is currently $3.7 trillion in dry powder. That's capital just sitting there, actively waiting on the sidelines to be deployed.
So, why is this capital moving so aggressively? The answer is pretty simple: performance. The data proves that private equity has consistently delivered stronger returns than public markets across 5, 10, 15, and 20-year horizons. And yes, that's net of fees. Institutions are more than happy to capture that illiquidity premium if it means accessing the 87% of U.S. companies that remain private today.
And hey, this isn't just an American phenomenon, it is totally global. A fascinating study of over 150 Finnish institutional investors, including their massive state pension funds, reveals a pronounced systemic decline in bond allocations. They're actively ripping out bonds and replacing them with alternatives. Crucially, the researchers noted this is not some temporary cyclical trade, it is a permanent structural evolution. Which brings us to Section 3, the 30-30-20-20 portfolio. If 60/40 is struggling, what is the actionable alternative? Enter the 30-30-30-20-20 portfolio model. This architecture aggressively pares down those traditional stock and bond exposures to actually mitigate modern inflation risks. The framework breaks down exactly like this: 30% public equities, 30% alternatives, 20% in inflation-protected and real assets, and just 20% left in fixed income and cash strictly for liquidity needs.
Let's zoom in on that crucial 30% alternative sleeve, because honestly, this is where legacy models fail completely. It's strategically divided to do the heavy lifting. You've got 10% in private credit targeting 8 to 12% yields, another 10% in private equity and venture capital, then 5% in real assets like real estate for inflation defense, and the final 5% in true hedge funds for non-correlation. This is exactly how sophisticated leaders are engineering yield today.
Moving to Section 4, democratizing alternative investments. Because this brings up a huge operational hurdle. How do we actually expand access to these highly lucrative markets beyond just the mega institutions?
Well, we are currently seeing a rapid democratization pipeline that is completely reshaping wealth management. First up, evergreen funds. Partners Group is a great example. They now manage 17 evergreen funds holding $44 billion, offering private exposure without those agonizing decade-long lockups. Second, minimum capital commitments are plummeting across the board. And third, policymakers are actively exploring how to get alternative access into 401k plans, which is going to open the floodgates to everyday retail capital.
Combine that massive institutional rotation with this brand new retail access, and the projections are just mind-blowing. Global private market AUM is expected to compound at 9% annually, hitting an incredible $60 trillion by 2033. But here is the operational reality check for us as executives. Handling a tidal wave of capital this large requires entirely modernizing our back-office infrastructure.
And that leads us perfectly into Section 5, tokenizing real-world assets. Let's explore the technological frontier being built to handle this incoming $60 trillion wave.
Enter real-world asset, or RWA, tokenization. In plain English, this is the process of representing legal rights to a physical asset through a cryptographically secure digital token on a blockchain. It replaces centralized, clunky, outdated databases with highly transparent, fractionalized ownership. This innovation has already unlocked a $24 billion market today, and the experts project it could absolutely skyrocket to $30 trillion by 2034.
Now, I know what you're thinking. What about custody? What about the legal side? Totally valid. For financial executives, those are always the immediate roadblocks. So it's absolutely critical to distinguish between on-chain and off-chain tokens. On-chain means all the vital legal parameters are embedded directly into the blockchain ledger itself. Off-chain means the token acts more like a digital receipt, while the underlying asset, like a physical property deed or a gold bar, remains secured by a traditional third-party vault. Mastering this specific architecture is non-negotiable for compliance moving forward.
And you can't talk tokenization without talking about the smart contract revolution. Think of these as programmable rules that are permanently attached to the token. They completely automate yield distributions, corporate actions, and highly complex compliance checks. Say a buyer isn't KYC approved. The code simply rejects the trade, automatically. And legally speaking, English courts have already signaled they are ready to enforce smart contracts just like traditional agreements, provided those basic tenets like offer and acceptance are present. It's a real game changer.
Ultimately, when you pull all the research and data together from across our sources, it points to one inescapable truth. The modern financial ecosystem demands a more sophisticated, diversified approach. Clinging to the legacy 60/40 model is no longer just a safe default setting. It is a conscious choice to accept lower, risk-adjusted returns in a fundamentally changed world.
So, as we wrap up this explainer, I want to leave you with one critical question to think about. Is your infrastructure ready for the $60 trillion private market future? The shift toward alternatives is happening right now. The capital is already moving, and the blockchain plumbing is maturing fast. Are you positioned to lead in this new paradigm, or will you be left managing yesterday's portfolio? Thank you so much for joining me today. Keep innovating, and I'll see you next time.